My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. If you want to make friends, I'm just trying to help you save some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It's mighty hard to keep your bat on your shoulders on a day like today. Market sells off, Dow sinking 222 points, S&P declining 0.17%, NASDAQ actually inching up 0.18% because of a stock, just a handful of those big tech stocks. Normally when the market throws a sale, I tell you to do some buying. Even now, I'm tempted because it looks like the Federal Reserve may finally be out of the picture, thanks to the recent economic data we've been getting. I think it's cool enough that they might not need to hit us with any more rate hikes anytime soon. But I can't endorse buying into weakness here because of the debt ceiling fight. Based on the last debt ceiling crisis, this market could have a lot more downside before we get a deal. And that's assuming we get a deal at all. Maybe the government ends up defaulting on its obligations. That's very much on the table, despite protestations from both sides of the aisle that it'll never happen. Right now, with the economy slowing and tax receipts coming up short, we might bump up against the limit by the end of the month. On the one side, you have President Biden, who's been unwilling to negotiate in any substantive form. On the other side, you have Speaker McCarthy, who's giving the appearance of being willing to negotiate, but his suggestions have very little chance of leading to any meaningful compromise. In the end, I think the White House will have to blink because the two sides, frankly, aren't evenly matched. President Biden's running for re-election next year. He can't afford to let a default happen or even a recession sparked by fears of default because presidents don't get re-elected when the economy sours. But Speaker McCarthy, well, he doesn't publicly said he doesn't want a default. He's not going to lose his job if he lets it happen. If anything, his caucus might actually reward him for it. At the very least, he'll have an easier time with the hard-right portion of his party that's given him so much trouble. We don't really know what will happen, but as a stock guy, not a politics guy, I just want to compromise. I don't care what's in it as long as the government can keep paying its bills and you can make money owning stocks. Fortunately, as I've been mentioned before, we have a clear analog, and that's the debt ceiling crisis of 2011. When we almost defaulted. So assuming we follow a similar trajectory of what groups did best and what groups did worse during the months-long torture, it was a whole month and a half, basically, of the first debt ceiling crisis that caused a 19% decline from peak to trough. What worked back then, well, perhaps that can work now. First, as you might have guessed, we can buy the stocks of literally any drug company because even though Medicare bills could be on the line, Wall Street's a lot more worried that a government default will trigger a recession, not a bunch of unpaid bills to, say, Merck, which was one of the standout performers in the last crisis. Yep, the pharmaceutical stocks were the first to bottom in 2011, and that was after the sovereign debt downgrade by the Standard & Poor's. That was an insult to the injury of the debt deal, something which was every bit as savage as the actual negotiations. Who fits the bill this time around? Well, at this moment, it's Eli Lilly, which is on the cusp of the largest drug launch in ages. I'm talking about Mounjaro, which is Lilly's revolutionary diabetes drug that doubles as a weight loss treatment. We've got a huge obesity problem here in America, so you can assume the sales will be off the charts. That's why Lilly's such a large position for my charitable trust, as Investing Club members have known for ages. On top of everything else, the same drugs being studied for cholesterol, blood pressure, and heavy drinking. None of which are in the numbers, nor is the potential of Lilly's Alzheimer's drug candidate, which, when you got two possible home runs, the debt ceiling debacle can't derail your story. Second to bottom in 2011 were the consumer product stocks. Now, here I'd be thinking of Procter & Gamble, which held up very well during the decline of 2011. Or how about Kenvue? That's that recently spun off consumer health business from J&J. More on that one later. Coca-Cola stayed strong, but this time around, the star of the show is PepsiCo, because snacking has become far more ingrained in our lifestyle than it was in 2011. PepsiCo, like Lilly, is a fabulous performer. Buy. If you want food, then you want Mondelez or Hershey. Two amazing performers. Mondelez is crushing with cookies, but nothing's working as well as candy maker Hershey. All these stocks share one major characteristic beyond consistent demand, and that's a decline in costs, resulting from the end of supply chain problems from COVID and lower commodity prices, and yes, cheaper transport. Now, what I'd also consider Colgate as a possibility. It's a sleeping giant that awoke that last quarter. It seems poised for a nice run. One of these should definitely be on your shopping list. I'm trying to figure out which one might be best for the Charitable Trust when we convene for our club meeting next week. I'm not sure which one to pick yet. Stay tuned. Next to bottom in 2011 was fast food, as McDonald's was a total store, just a star back then. Hey, that was perhaps because Wall Street assumed people would trade down to Mickey D's. The Golden Arches pretty much had the field to itself back then. Still worth considering, along with Yum Brands, Restaurant Brands, and Chipotle. I like what I heard from Wendy's yesterday, too. I hope you did. Finally, mission-critical tech worked back then, tech that facilitated the Internet's growth. Hey, I guess some things don't change. This time, it's worth looking at the ones that can help you mine big data for your own advantage. That's right, artificial intelligence can make a company do far more with less people, less money. You need a consultant to do it, though. And right now, those consultants are Microsoft and Alphabet. Now, NVIDIA and Meta platforms are benefiting, too. Each does a different thing. You need NVIDIA cards to run such complicated software. Alphabet and Microsoft are integrating AI into the rest of their commercial products. Meta's using AI to get around Apple's privacy restrictions and once again deliver targeted ads to you. Boy, the advertisers love that. Over the coming weeks and months, I'll explain how they use artificial intelligence to help their clients. What matters is that you need one of these icons of AI in your portfolio. Please wait for the market-wide pullback from the debt ceiling fiasco before you pull the trigger. Considering that the president just pushed back a key debt ceiling meeting to next week, I expect you're getting a bearish opportunity to do some buying. Everything else didn't make the cut or took too long to bounce back in 2011. That's because both the consumer and enterprise conserve cash, spending less for fear that they need it. You husband your cash when you think there'll be a recession, right? And that's what people thought in 2011 until the all clear sounded. During that period, you did nothing but lose money every day in almost every other category. So the bottom line, be careful and use the parameters I've laid out. That way, even if we get a default that triggers a recession or Wall Street believes that we're going to get one, your portfolio can still come out relatively whole. No sense in leading you astray, though. The debt debacle and the downgrade of the U.S. debt by a ratings agency did a ton of damage to stocks. We're only trying to pick which ones went down the least because everything performed poorly. Let's go to Emil in New York. Emil.
Hi, Jim. Hope you're doing well.
I am. I hope you are the same.
Good. Thank you. Long-time listener, second-time caller, and a club member.
Oh, thank you for joining the club.
Regarding a stock in retail, cosmetic, and beauty sector. I brought this stock a couple of years ago. You've spoken about it highly over the past several years. It reported about 3 months ago a very nice quarter, and the price action was very nice on the stock. I added some more to my holdings because I thought it would be a good stock to have in a possible recessionary environment. And then for the past month, the stock has been going down pretty rapidly, about 10%, although it had a nice bounce today because of an upgrade from an analyst. Some of the cosmetic companies, Coty and Elf, has been doing very well. The stock I'm talking about is Ulta. There's not much in the news.
Ulta's easy for me. I've been recommending Ulta. If you recall, when Mary Dillon took over many years ago, I started recommending it. And then Dave Kimball came in. They are doing a terrific job. By the way, I recommend people going, if you don't want to go to Ulta Beauty, and I do love their stores, go to a Target. You can see a lot of great products there. You see what Ulta Beauty's doing. They are really making it so that a lot of cosmetics that used to be very expensive are inexpensive. Let's go to Mike in Illinois. Mike.
Jimmy Chill.
Hey,
nice
Mike,
to
what's
talk
up,
to you. Long time, first time.
Thank you. What's going on?
Hey, I'd like to give a big booyah to my son Hunter out there. My question to you is about Devon Energy. I bought in when we talked about this about 2 years ago. I rode the train all the way up to 75, cashed out some profit, been holding the rest. Just wondering, should I buy, hold?
No, I don't want you to buy more. I mean, Rick Munker was on the show. He did a terrific job, and Devon is a good company. We made a lot of money for it, for the club. However, the oil stocks are right now in retreat. They did not do well in the period that was like this in 2011 with the debt ceiling. Let's wait till we get past the debt ceiling issue and then revisit the oils. Let's go to Kyle in Illinois, please. Kyle.
Hey, Jim. Kyle from Chicago. How are you?
I'm doing fine, Kyle. Thanks for calling. What's going on?
Well, I'm in Chicago, but you know what? I spent 20 years in Columbus, Ohio, and there's a little bank there called what we call H-Bank, and it's still my bank today. And you go north, and it's KeyCorp. And you go south, and it's Fifth Third Bank. From the Great Lakes to the Ohio region, I bought all three yesterday, and then I woke up today, and they're all down because of a little bank in Beverly Hills, California. Am I early on buying all these three Midwest banks?
I've been thinking of HBAN as Huntington Bankshares. They've been on the show. Mr. Steinhauer is terrific. I don't recommend any of the regional banks until we get through this crisis. The reason I don't is because we keep getting hit by things like, for instance, the FDIC is proposing much larger fees. So now we say, oh, geez, we got to cut numbers on these. I mean, we're in a world of
the House of Pain.
This group, and I like to stay out of that address, but thank you for the call. Look, the debt ceiling is a real overhang right now, so tread lightly and stick with the winners that could lead the market higher once we get a resolution. We're mad tonight. As I mentioned, the debt ceiling crisis does have the market on edge. But what are the technical signaling? I'm going off the charts to find out. Then the turbulent economy put the IPO market on pause. But it got a shot in the arm last week with Johnson & Johnson's spinoff of Kenvue coming public. I'll tell you if it's worth considering. I know many of you are thinking about it. And earlier this week, I told you travel and leisure was one of the sectors showing signs of strength amid the uncertainty. So could boating fit into the investing thesis? I'm getting a read on the space with the CEO of Brunswick. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.